Guillaume Prache, Managing Director, Better Finance. Today you organised an event on pension savings, the real return. Why are returns so poor and what can be done about this at an EU level?
Yes, we just published our 2015 research report on the real return of pension savings because we are the only one to do it on this comprehensive basis. Yes, unfortunately, overall, although they have improved from last year, the long-term returns are quite disappointing. They are very diverse, but mostly disappointing. Some are even negative after inflation, which is a big problem for EU savers, pension savers. We looked at the factors explaining these poor returns overall. There are some exceptions. The number one is really commissions and fees, which is a problem because first, in many products they are very high, but also a bit opaque. I mean, not fully disclosed. One example, for example, is unit-linked insurance, where you have at least 2 layers of fees, and it was very difficult to find out the total amount of fees. So fees is the first reason, and the second is what the technical people call asset allocation, which means how much you put in shares, how much you put in bonds, roughly, and some other products. And some people put a lot in equities, but some people put a lot in bonds, or in certain bonds, or in certain equities, and that also had an impact.
Do you think a pan-European personal pension could help? And are we any closer to achieving that?
We are very, very supportive of a pan-European personal pension product, a PEPP, which is now being worked out by the European authorities. The two problems, it will have to be simple, low cost, and which is the big if, to get the most favored nation treatment in terms of taxes. Because every country, including the UK, France, Germany, have their own system of tax benefits or treatment for these personal pension products, the existing ones. If the PEPP doesn't get these favorable treatments, of course it will never succeed.
Thank you very much. Lubomir Christoph from the Institute of Certified Financial Consultants in Bulgaria. Can you tell us a little bit about the Bulgarian situation with pensions?
The Bulgarian situation with pensions is unfortunate. People have been saving in private pensions for the last 15 years with the hope of getting more adequate pensions when they retire. Unfortunately, over the past 14 years, the returns on private pension funds were negative, and people are likely to receive less pensions in retirement than they would have had they stayed with publicly managed Social Security.
Didier Davidov of the European Savings Institution, you've led this study on European savings, the real return. What does it tell us about the situation in different countries in Europe?
Well, actually, it depends on the country. It can be completely different from a country like the UK, where you have a huge amount of money which is invested in pension funds. In some other countries like Italy, where the people rely on the social security. In 2014, the returns have been better because the pension funds have made some capital gains due to the decrease in interest rates. But obviously, this may be changed next year if there is an increase in interest rates, and it will be interesting to follow up the studying to see whether the returns are still positive, because we try to measure the returns of pension products after deducting the inflation, after deducting the commission and fees, and after deducting the taxes. And then it's really a challenge to offer a positive return to investors.
You've talked about the situation in Bulgaria, but more broadly, what does this mean for EU citizens across Europe?
What it means for EU citizens and worldwide is that people who are very busy with their daily lives, with raising families, with doing their jobs, be it as lawyers, architects or other professionals or blue-collar workers, they want to know if they are doing it all right now, will they have dignity and sufficient funds in retirement. That's why this is important for everybody.